Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. And you can find me on the web, as always, at elevationfinancial.com. All right, today, does dividend investing live up to the hype? Dividends. People like to talk about dividends. They're on social media all the time. So dividends are one of the most widely discussed aspects of investing. You often see headlines like, these dividend stocks can protect you from the next market drop, or dividend stocks are primed for a comeback in whatever year you're in, or 5 dividend stocks to hold for the next 5 years. Like they just make these claims. Social media is full of finfluencers, which are financial influencers. They called finfluencers for short sometimes, who often imply that dividends are a magical wealth building tool that will make all your dreams come true. It's easy to assume that dividends are a really simple, magical, consistent way to earn income while investing. But the truth is a little bit more complex. Dividends can be attractive, but they shouldn't drive your entire investment strategy typically. So let's talk about dividends, where they come from, why investors are drawn to them, and how to think more strategically about total return and diversification. So what are dividends? Dividends are a way for companies to return cash to shareholders. But they aren't the only way. When a company earns profits, it has several options, including reinvesting those earnings back into the business, buying back its own shares in the open market, or distributing cash to shareholders through dividends. So the proportion of companies paying dividends has actually dropped significantly over the past 50 years. Companies nowadays aren't paying dividends as often as they used to. But why do people love dividends? Why are they so attractive? So there's a few motivations behind this. One is income. So retirees and near retirees often like the idea of regular income hitting their accounts. They like seeing that cash just kind of come in to their accounts. Stability also. Sometimes dividend paying stocks are seen as more stable. They also are attracted to the perception of higher returns. Some investors believe that dividends offer a way to boost their total return. So each of these has some merit, but there's some important caveats. So let's talk about income first, the income illusion. Many investors think of dividend stocks as a reliable source of income, kind of like a paycheck from their investments. But unlike bond interest, which is contractual, dividends are discretionary. Companies are under no obligation to continue paying them. In fact, during economic downturns, dividend cuts are not uncommon. For example, in fact, during the first 3 quarters of 2020, during COVID, total dividend payouts from U.S. companies dropped 22% compared to the same period in 2019. So if you're depending on dividends as your income stream, you're depending on a cash flow that can go away potentially when markets turn volatile. So instead, think in terms of cash flow, which is how you can best generate the money you need when you need it in a flexible and tax efficient way. It doesn't always have to come from dividends. Let's also talk about the capital trade-off. It's a common misunderstanding that dividends are a bonus or an extra return on top of capital appreciation. But in reality, when a company pays out a dividend, its stock price typically drops by the amount of the dividend. So let's say a stock is worth $10 and pays a $1 dividend. The next day, the stock's value drops to $9. You still have $10 in total, which is made up of the $9 of the stock value and $1 in cash. So that's why it's important to focus on total return, which is the combination of price appreciation and income. Whether your return comes from a dividend or selling a portion of your investment, it's functionally the same. It's money out of one pocket into the other. Plus, selling shares gives you more control over when you generate income and how it's taxed. Dividend income is taxed when it's paid, whether you need it or not. But selling a share can allow you to manage capital gain taxes more efficiently. So let's talk about diversification. One of the biggest downsides of a dividend-focused strategy is limited diversification. Less than half of publicly traded U.S. companies pay dividends. That's a smaller slice of the market, and relying exclusively on dividend payers could mean leaving out some of the most innovative or high growth companies that you might want to be exposed to. So even some of the most successful companies didn't pay dividends for much of their history. Microsoft, for example, didn't pay a dividend until 2003, which was 17 years after going public. So what about stability? Are dividend stocks more stable? Dividend payers are often perceived as more stable, but the data tells a little bit more of a nuanced story. So yes, on average, dividend paying stocks have shown slightly lower volatility than non-dividend payers. But the difference is not dramatic. Both categories still experience the ups and downs that are typical of equity investments. So if you're really looking for stability, fixed income instruments like bonds are designed to provide that. While dividend stocks, even if less volatile than some others, still carry the full risk profile of equities. They're still stocks. So let's think about total return, which could be a smarter way potentially to approach investing. So instead of chasing dividends, you might be better off focusing on a total return strategy that looks at the overall growth of the portfolio, regardless of where the return comes from. So that sort of strategy is going to give you more control over when and how you access the cash, potentially better tax efficiency, potentially broader diversification, and the flexibility to capture wider returns from a wider universe of stocks. So you can design a portfolio that emphasizes profitability, value, size, which are all factors that have historically been linked to higher expected returns, without having to rely on a limited subset of dividend payers. So ultimately, it really comes back to your plan. And if your goal is to generate cash flow to meet your lifestyle needs, it's going to make sense to step back and ask, one, what are my spending needs? Two, what cash flow do I need from my portfolio? And three, how can I meet that need in the most effective and tax efficient way? So dividends aren't bad, but they're also not a shortcut to financial success. They're not this magical wealth building thing that influencers like to pretend they are. So if you're drawn to the income that dividends provide, take a closer look at what you really need. You might find that a more diversified total return strategy gives you the flexibility, the control, and the long-term growth potential that you're really after. So start with your true goal rather than anchoring to a specific investment type like dividend paying stocks. And that's going to help you build a strategy that's aligned with your life and not just the finfluencers and the headlines out there. All right. Hope that's been helpful. As always, you know where to find me if you've been a listener for a while. It is elevationfinancial.com. You can send a message through my website or find me on social media. Or if you'd like to chat in real time for a bit, or even ask questions about potentially becoming a client, you can book a free consultation on my website, which again, elevationfinancial.com. All right, everyone. Thanks for joining me today. Have a great day. We'll see you next time.